How does inventory affect the balance sheet? Have you ever wondered how inventory plays a role in a company's financial health? Understanding this can be key to making smart investment choices. Let's break it down. Inventory is classified as a current asset on the balance sheet. This means it includes goods that a company owns and plans to sell or use in production. The value of this inventory directly impacts the total assets reported, which reflects the overall financial position of a business. When we look at banks and credit unions, inventory is significant for several reasons. First, it contributes to current assets. Current assets are those expected to be converted into cash within 1 year. A higher inventory balance boosts current assets and working capital, which is current assets minus current liabilities. This measure indicates short-term financial health. However, if a company has excessive inventory, it can inflate asset values and mislead lenders about liquidity. Next, the way inventory is valued matters. Companies can use methods like first in, first out, last in, first out, or weighted average. These methods affect how much inventory is reported on the balance sheet. Changes in inventory value can alter total assets and owner's equity, which is assets minus liabilities. For banks and credit unions, accurate inventory valuation is essential for assessing collateral value and borrower stability. Now let's talk about inventory write-downs. If inventory becomes outdated or its market value drops below cost, a write-down occurs. This reduces the inventory value on the balance sheet, decreasing total assets and retained earnings, which are part of equity. For lenders, such write-downs can signal risk in a borrower's operations and influence lending decisions. Companies often finance inventory purchases through loans or credit lines, which increases liabilities. Banks and credit unions keep an eye on the relationship between inventory levels and associated debt. This helps them assess whether a borrower is over-leveraged or managing inventory efficiently. Inventory levels also impact key financial ratios that banks and credit unions use. Ratios like the current ratio, which is current assets divided by current liabilities, and asset turnover ratios are influenced by inventory. Proper inventory management can improve these ratios, signaling better liquidity and operational efficiency, both positive indicators for lenders. Lastly, inventory ties up cash. Overstocking can limit available cash for other needs, while understocking might lead to lost sales. Banks and credit unions consider inventory management practices when evaluating a borrower's cash flow stability and ability to repay loans. In summary, inventory significantly affects the balance sheet by representing a large portion of current assets. It influences total asset value, equity, and financial ratios. For banks and credit unions, understanding the role of inventory is vital for assessing a business's liquidity, operational efficiency, and credit risk. Accurate inventory management is essential for reliable financial statements, which are the foundation of lending decisions and risk assessments.